So the whole idea of this session is just to look at the new Finance Act 2020 and the effect on payee tax. What I'm going to be doing basically is that I'll be reviewing the old payee tax in terms of what are the requirements. Then will now be looking at it in the light of the new Finance Act 2020 that was signed 31st of December and took effect 1st of January 2021. So that's what we're going to be doing today. So for as many of you that are very familiar, I know some of us are familiar with payee calculation before, why some of us may not. So, but it's a good one because for those of us that are in the HR function, we're going to be explaining to our staff and we're going to be engaging them on what the effect looks like basically. Going by the new Finance Act 2020 and payee tax. So this is the first thing I'm going to do. I'm going to explain ordinarily, if you were looking at the current PICTA 2011 as it stands, that's your pay assets as you earn. The major feature that you need to take note of that changes in the new Finance Act definition is how gross income is defined. So according to PICTA 2011, it actually defines your gross income as wages, salaries, allowances, including benefits in kind, gratuity, bonuses, and other incomes derived solely by reason of employment. Now, as a result of that definition, when you want to calculate your payee tax, you need to do what we call your tax relief. There's some element of the relief that is tax-free, and that the first one is your consolidated relief allowance. Now, your consolidated relief allowance is defined in two elements. There is a fixed part and there is a variable part. Now, the fixed part talks about 200,000 or 1% of your gross income, whichever is higher. That's one part. Then the second part talks about your 20% of your gross income. Now, this gross income, how it is defined is the difference between the current, or let me say the outdated payee tax definition, which ended at December 2020, and the new one that kicked in 2021. The main difference or the main point of reference that you need to take note of is the definition of this gross income. So the point of contention, the major difference between before 2021 and now is this definition of gross income. That's the major thing. So initially, your gross income definition is your gross pay. So your gross pay is defined as your gross income. But in the new Finance Act 2020, that will now affect 2021 payee tax calculation, this is where the definition changes. The definition of the word gross income. So there's a section in PICTA 2011 that was adjusted, and that entire wording was adjusted to mean that for the purposes of this section, gross income, so take note, gross income is what determines your variable consolidated relief allowance, which is tax-free. Meaning your tax-free element means that you would calculate 20% of your gross income. Before 2021, it used to be your total gross salary, your annual gross salary. But by virtue of the Finance Act, it is now redefining what that gross income means. And it says that it means income from all sources, less all non-taxable income. So initially, your gross income was defined as the entire annual salary. So you do 20% of the entire annual salary. It's the variable consolidated relief allowance. But by virtue of Finance Act 2020, which took effect in 2021, 1st of January, you will now, in defining your gross income, which will determine your variable consolidated relief allowance, you have to take away the non-taxable parts, which has to do with the tax exempt element, talking about your pension, your NHF, because they are tax-free element. Now, you would subtract them from your annual salary before you can now calculate 20% of that as your variable consolidated relief allowance. So let me stop sharing this and let me share the Excel file so that I can easily expatiate. The language and the story seems to be getting too much. So let me just take it sorted. Let me just take it one after the other. Now, this Excel file that I shared with every one of us, please take note. There are some things that will change. The first thing that is most likely going to change is this. For most organization, this thing is not a plug and play. So for most organization, the breakdown of the pay is different. What that means is that this rate will be different from most organizations. So I have noticed, I've actually had time to answer some questions. So a few of us have chatted me up one-on-one, and I said this is going to change. So take for example, we're going to come to this in a minute, but let's see what the differences are going to be. So ordinarily, before 2021, your breakdown, which is the salary breakdown, is not going to change. But this is where the changes now start to come up, which is where you need to take note of that changes. The first change is this one. I mentioned that the gross income definition is what will change. So ideally, in your before 2021, if you are calculating your variable, look at this element. If you are calculating your variable relief allowance, you will do 20% of gross income. Now, that gross income used to be your gross pay. No issues. That's why you notice that in this definition, it is 20% of your gross pay, which is this, your gross income. Now, but the difference now, then you now still subtract your employee pension, your NHF, to get your tax-free element that will be subtracted from the annual gross. Then you can now be able to apply your tax table in terms of this formula. Then you'll be able to know what your annual tax looks like. But by virtue of the adjustment to the Finance Act 2020, it now says that instead, now the 2020 Finance Act now adjusted your definition of gross income to say that ideally what you will have done is to do 20% of your 5 million in this scenario. But it now says no, you cannot apply that variable consolidated allowance on your 20% on your gross annual salary. No, don't do that. It's now saying that what you should first do for the sake of calculating your CRA is to subtract the non-taxable element from your annual salary, which means ideally for somebody earning 5 million naira, before you can know your gross income, subtract your employee pension, 8% of basic housing and transport, subtract your national housing national housing fund, 2.5% of basic, then which means that your gross income is now lesser than 5 million. Then when you now want to calculate your consolidated relief allowance, which ideally would have been 20% of your annual salary before 2021, what you now do in this scenario is that you would have subtracted your pension and NHF from it, which means instead of using 5 million, you use lesser than 5 million. And the implication of that is this: 20% of that will now mean that you are having the tax-free element as reduced. And ideally, it will have been 1 million for this scenario of 5 million naira. But in this scenario, it's now going to be 931. And what that means is that more amount to be available to be taxable income. That's why you notice you now still do your normal deductions of your normal tax-free, which will now be total of the tax-free element that you now subtract from your 5 million, which is on the normal before 2021, before the Finance Act. In this case, you notice that the taxable income is higher here, is lower, meaning the taxable income here is lower because your tax-free is high. But here in the new Finance Act, your taxable income is now lower. which means there are more money available for taxation. You now notice that there's a difference in the tax amount for both, and you now be able to notice that in this scenario that we used, ideally an employee that will have been earning 336 in terms of net will now be earning lesser, which is just about 1,000 naira depending on the amount. So that's my first explanation. I think I would open up conversation for questions now, so that we can now ask specific questions to help us clarify this new matter in our face. So